Good afternoon, and welcome to Thornburg Investment Management's 2026 Outlook webinar. I'm your host, Josh Rubin, a client portfolio manager for Thornburg. Joining me today is Christian Hoffman, head of our fixed income, and Matt Burdett, head of equities. So I think for a long time we've been talking sort of about this foundational question for equity investors. Where will returns come from in the future, both from a geographic perspective or sector perspective, but also capital appreciation versus income? And 2025 was a year that looked different than a number of the years in the past. We saw international equities outperform U.S. equities last year. And although U.S. indices still provided solid returns, each region achieved the returns differently. The U.S. market has become highly dependent on some of the biggest companies. Can you talk about what you think this indicates about the health of global equity markets and the opportunity for stock picking in the U.S. and international markets going forward?
Sure. No, thanks for the question. Look, I think, investors should always ask themselves, where's the total return going to come from, right? In equities, it's earnings growth, it's multiple expansion or compression, dividend yield, and if it's a foreign stock, you have a currency impact, right? And the currency impact was, in particular, a benefit to dollar-based investors in 2025, and I think people kind of saw that diversification benefit come through. They've been told that for many years, and it hadn't really paid off. But last year, I think, was a year where that kind of shined. But there are material imbalances, I would think, in the stock markets, in particular the U.S. market, and it has to do with just rising concentration levels, right? I mean, there's numerous factors that contribute to that. One, the continued rise of passive investing. Two, the monopolistic tech companies that only the U.S. has, right? I mean, some other countries have good semiconductor companies, but the U.S. has the large, subscriber-based tech companies, right? And then the other driver is massive capital flows into the U.S., right? And on the screen, the audience can see the percentage in the U.S. market attributed by the top 25 stocks. And what you can see is from going back to 2022, that was 37%, and then it went up all the way to 51% in the U.S. In 2025. Compare that to international markets, it's kind of been 20%, and it got up to 21% in 2025. Mm-hmm. So it's not nearly the concentration in weight. And then if you look on the right-hand side of the slide, you can see the contribution of total return, which is even more extreme, right? So if you look 2024, the top 25 were 72% of the total return, mm-hmm. right? So that means that the other 475 didn't matter very much, or mattered far less, right? Mm-hmm. That's not as true in the international markets, as the slide highlights. So, equity market structure is also very different today than it was even 5 years ago, much less 20 years ago. A lot of the volume traded, especially in the U.S., is not based on perceived value of a stock. It's based on something else, mm-hmm. right? High frequency trading, quant, trend following, all of these things. And when you have an environment where there's no real disruptive force to that, you can get these kinds of extremes, that we're seeing. And, viewers can see the slide on the screen that highlights, if you go back to 2016, the international markets, which are the chart on the left of the screen, were about the same size in total market cap as the U.S. And then as the Mag 7 and this concentration in the top holdings really took off, which is what you see on the right and the purple shading, you can see that just extreme levels of differences in total market cap, over this time.